Hey, welcome everybody to the 40 Finance channel. I was trying to make this into a recorded video, but I ran out of time today. But today I've got 12 very important stock market investing charts that everybody should know. So we'll be taking a look at that. And here we are at the end of the year on another downturn with the stock market. And it's hard to tell if there's going to be any upside because we're really in the very, very short term. We're also facing tax loss harvesting, not only this week, but into next week. I'll be doing some of that myself. But these charts are not the charts that I'll look at today. These are not charts about the next 2 weeks, right? And quite frankly, I'm not sure how many retail investors are even thinking about buying stocks right now. If you're like me and you're managing a household and, Christmas gets expensive, so, for many people, they're looking ahead maybe to January and just putting the noise behind them. But these charts are going to be applicable for that time too. In my world, I'll be looking to shore up. I have some capital gains from some positions I've sold this year, and I'm going to balance those off with some tax loss harvesting. Won't be a big deal. I think it's only $4,000 or $5,000, but I'm going to take advantage of that. But when we're thinking about the long term, we are definitely starting to get to a period, whether that's today, January, February, where you have to start asking yourself where the bottom is. And we've been talking about the bottom for a long, long time, essentially all of 2022. So it will be interesting to see when the uptick happens. Will it be prior to earnings, which most of the important ones will come out in February, or is it going to take even longer? TBD on that. But welcome everybody, and let's jump in to our charts. Actually, quick announcement here first. If you did not see the last video, Seeking Alpha is having their end of year flash sale. Unbelievable, $39 for the entire year of Seeking Alpha Premium. My affiliate link is in the description if you're interested in learning more about that. There's also a review video down there. So incredible deal, and that is not per month, that is for the whole year. So roughly on some poor math, that's $3-ish a month, and give you all the stock market research that you need for 2023 and what could be a very exciting bounce back year. Maybe not bounce back to par, but to think it could go much lower, I think you're starting to play against the odds. If you're betting on the market going much lower than here, we'll see how it turns out. All right, let's talk charts. And the inspiration for this, again, I bookmarked this tweet. This was November 29th. I bookmarked this tweet because I was going to go through and make a video about it. I thought it was a good collection. I don't know this person, Matt Allen. They have 52,000 followers. He is the author of the tweet, so I do want to call out and give credit where credit is due. But here's where Matt Allen, here's what he put together. 12 charts every investor should know. The first one is the psychology of a market cycle. And this is a pretty cool one here. We've seen a lot of this over the past, let's just say 12 to 24 months, about how, this euphoria and stuff that we saw on the upside, how long would that last? And then probably the thing we've talked about the most this year is what level are we at here on the downside? Is it anxiety? Is it denial? Is it panic? Capitulation, which is the one that everybody is sort of hoping for, I guess, so they can jump back in. Then there's anger, and then, this flat line into depression. And then on the way back up, interesting enough, you have disbelief that this is a sucker's rally, as they say. And the one part about this that's probably more important than what stage we're in and what is that stage called is this top graph right here. Because you have a peak, you have a recovery, and down here is the trough. And notice, if you say red is the bottom, And, there's more colors to being profitable here, orange into yellow, etc., depending on where you started. The red is the point of maximum financial opportunity. But it doesn't take a real genius to look at this and figure out pretty much anywhere from, give or take yellow into this blue rebound point is also an opportunity from a financial standpoint. So I think that we, in the mass media anyway, there's a lot of folks that wait for this signal of the bottom, like, Moses is going to come out with the commandments and say this is the market bottom, and then the next day everything's going to go directly upwards. And it really just doesn't work that way. And you're much better off if you're comfortable and you have the money to invest. It's just better off to plug and play throughout here from sort of a dollar cost average standpoint. You may not get it exactly perfect, but I will say with today, for example, with the market being down, I think the low on the Qs was in the 250 range. Today we're in the 270 range the last time I looked. So what if the Qs go to 245 and you bought at 270? All right. How bad is that? Well, if you only bought in small lots, I'm not sure that it even matters. And in my case, I'm lowering a cost basis from another time before, so it almost really doesn't matter. Think about how you can hold shares of promising names or at least solid names. How many shares can you accumulate for, let's call it, the next 5 to 10 years? That's when you really win. All right. Chart number 2 from Matt Allen. The caption here is, there will always be a smart sounding reason to sell in the short term, but you will regret it in the long term. And on this one, it'll be hard for you to read, I imagine. But this goes back to 1950. And it looks like this chart maybe ended in 2015, something like that. But it says, smart sounding reasons to sell stocks during a period the market went up 100x after inflation. I'm not exactly sure how they picked all these things, but obviously from a 1950 to call it 2015, we know what happened in the long term, right? We know that stocks went up over time, and you can see the various reasons of why people would have said sell at the different times. And I'm just going to skip ahead to a more modern era. Here in, let's just say 2000, we had Y2K. We had the recession and of course, the dot-com bust. We had 9/11. We had oil prices surge. We had bank crisis, housing bust, Europe debt crisis, deficits, slow growth. And that was just in a short-term timeline from 2000-ish to 2022. Okay, and we know that in that period, it did take the NASDAQ a little while to get back to par. I believe it was 6 years. Maybe it was 7, but for the NASDAQ composite to go from, let's just say whatever the high was in 2000, then we had the dot-com collapse. It did take a while for it to go back up. I'm one of the people who argues that the dot-com collapse was significantly different than what we're facing today, i.e. a basically engineered recession, right? We're going through an engineered boom, and now we have an engineered recession. That's a lot different than assets who were, fundamentally worthless from the time they went on the market, and they collapsed and there was nothing to bounce back on. Whereas if you look at at least the QQQ in the top 100 portions of the NASDAQ, there is value there. We can argue all day on what the multiple is, but you do have companies that are earning EPS and have revenue earnings growth. All right, chart number 3, and this is a real eye chart, so we'll just look at it for a second. This is the history of the stock market in one chart, and I can barely read the 121 points that they have here in history, but you do get the synopsis as it starts back in the late 1800s. to where we are today, it does call out a couple of the recovery times. So if we go back to, let's just say the Great Depression, which is, I guess I had it down roughly as 1929 to 1939. Maybe it was slightly off on that. But the bottom line is the Great Depression, recovery time, they're saying 25 years for that. So do you think we're in the Great Depression? Do you think that we are not able to produce anything? Do you think our farmlands have run dry? I do not agree with that particular sentiment. However, that's what you'll hear. Some people say that your recovery time's forever. And if you believe that, then, I guess we'll find out, right? I guess we'll find out depending on what we bet on. Next up, in the 70s, you had a 16-year recovery time from approximately 1970, I have to get lined up here, from 1965 right up to the Ronald Reagan years. You had a stretch in there with several, you had inflation, you had oil embargoes, you even had 3 Mile Island as I'm trying to read through this. So many different things went on. The 70s wasn't a particularly good decade to invest in. However, if you worked for 10 years in the 70s and you cashed out in the 80s, things did actually turn in your favor. And then the last one that I'll call out here, let's see if I can pick, what was 113. Okay, so this is the housing/credit crisis here. We don't actually have the COVID dip that represented on this particular chart. But if you even go back to the housing crisis and you go back to 2017 or 18 when this finally bounced back, that recovery time was 6 years. Okay, and most people's careers and most people's investing history spans much longer than 6 years. It typically, would span 25 plus years, and that, I would say, is maybe a little light. That would put you at 25 years old. If you invest for 25 years, that gets you to 50 years old. That's probably not, most people are going to be in it for longer, right? But this is the Dow Jones Industrial Average through the whole, the whole time period that it's been out there. So very interesting chart, good one to look at. Number 4, compounding is the 8th wonder of the world. This is $1 doubling 20 times, compounding tax-free, which would be sort of your 401k, and then compounding at a taxable rate of 25%. And either way, this 20 times, no matter which way you're doing it, you're still doing things the right way, as long as your money continues to make progress with interest, which eventually turns into doubles. And even on this, the theory of doubling, even if you just doubled your investment every year, not even the gains or the losses, but you doubled your investment every year for 20 years, you could still make a nice little nest egg just doing that simple thing. And let's say we change this, let's just say we change this to $100, right? And we doubled it at a taxable level, you would eventually get to, hopefully my math is going to be right on this, but $414,000 just by doubling your investment level each year over 20 years. All right, number 5. I love this kind of chart here. This is largest U.S. companies by market cap starting in 1960, basically per decade, right? If we go back to 1960 real quick, AT&T, GM, DuPont, Exxon, GE, IBM, Texaco, Union Carbide, Kodak, and Sears Roebuck, 1960. So of those, I would say AT&T still around, GM still around, DuPont, yes, Exxon, yes, GE, yes, IBM, yes, Texaco, I don't know if they're still alive as a standalone business. Kodak was basically out, even if they're still hanging on with, some sort of redirected name, and then Sears is obviously done. So 8 of the 10 in 1960 are still around. That's pretty good. We'll skip ahead to when I would say arguably the world changed the most, right, with the rise of the internet here in 2000. And you got Microsoft, GE, Cisco, Walmart, Exxon, Intel, Lucent, IBM, Citigroup, AOL. Of those, I'm guessing Lucent is out. I'm not familiar if they were acquired or not. Citigroup's still around, and then AOL, which was ultimately bought by somebody else. I believe Yahoo, who was eventually bought by somebody else. But that's not too bad. We're roughly 8 out of 10 in 2000 are still there. Now in 2020, Apple, Microsoft, Amazon, Alphabet, Meta, Tesla, Berkshire, Visa, J&J, Walmart, those are obviously all still here. And then just 2 years later, call it post-pandemic, you added NVIDIA, Meta, and Tesla and United Health Group. So we'll see where that, where that takes us. Sniff, what's going on? Good to see you. He says, we are all engineered by the juice, and we are in the last days, hopefully, I assume you're meaning the last days of the tough market that we're in. We'll see if that holds true. Stock chart number 6 is the best time to invest in the stock market. And for this one, they're going off of low CEO business confidence expectations for economy 6 months ahead. And the illustration basically takes the last time that CEOs had low expectations for 6 months ahead. And 2022 looks like, if you assume this is correct, this looks like the lowest CEO business confidence for the next 6 months in quite some time, if not since 85 or before. And then the chart below shows how the S&P 500 responded after that time or shortly after that time. So we see 91, and then of course there was an uptick in 91, 2002, we had another dip in confidence, and that stuck on through 2003 or so, but then it did eventually rise again. 2009, essentially the same thing. 2020, we know about that, and here we are in 2022. And of course, the question is, when do things bounce back, or is this the lowest point of CEO confidence? I think without question, once again, statistically, if you're dollar cost averaging for the long term, I would say the odds are in your favor that you're not overpaying. Let's put it that way. There's not a lot of people talking about stocks are historically expensive right now. It may not be historically cheap compared to 1970, but the risk of paying too much, I think we are reaching the end of any sentiment that goes that way. Number 7. This is a good one for all of us, including myself. Oops, let me read the caption first. The average investor is their own worst enemy. I think this has been studied quite a bit, but 20-year annualized returns by asset class, you got REITs at 10%. Surprising that gold's there. That surprises me for whatever reason. 7.7%, we got oil at 7%. S&P 500 at 5.6%. 60-40 blend of investment, 5%. 40-60s, 5%. Bonds, 4.5%. I don't even know that one. Homes, 3.4%. Inflation is winning at 2.2% on the average year. And the average investor does approximately 1.9% on their annualized returns by asset class. Obviously, the call out here, if you want to highlight in this middle column, S&P 500 at plus 5.6, 60-40 is at 5%, and a 40-60 is at 5%. So needless to say, us trying to do it by ourselves, if you're looking through last year like I am, there's not a strong case to say that you can beat this market by yourself. Probably the lesson anyway that I learned is that you need to have some format of these concepts here in your portfolio to balance off what seems like the inevitable mistakes that retail investors make. All right, number 8. This one was the hardest one for me to really grasp mentally, but I'll put it up anyway. And he gives a quote: "Insiders might sell their shares for any number of reasons." He's talking about corporate insiders, "but they buy them for only one. They think the price will rise." So talking about corporate insiders in this chart, let's see if I can bring this down. You can't see the top the way that it's being displayed on my computer here, but this is the corporate insider buy-sell ratio. And what we have on the green line is excessive, or excuse me, the top line is the SPY, S&P 500, okay? The blue line is corporate insider buy-sell ratio. So the ups and downs here is the buy-sell ratio, okay? And what we can see is with the green line, they call excessive pessimism, and the red line they call excessive optimism. So somewhere down here in 2020, you had excessive optimism, and then, of course, we know what happened to the market. And now you're reaching a part, while it's not the largest level of pessimism we've seen over the past 20 some odd years, or this chart goes back to 2011, it is getting up there, right? So if you wanted to make the argument that corporate insiders are buying stocks now, and they typically have a good track record of buying when the market goes up, then this could be a good time to buy. Not necessarily all in, very rarely an all-in guy, but it might be a good time to start nibbling depending on your situation. All right, number 9. Well, forgot to read it. Average investors have historically underperformed the S&P 500. This kind of goes back to the original chart. Fund investors, now this is a different time period, 98 through 2017. So S&P 500 for this time period was 7.2%. The last chart, it was running about 5.2. Average stock fund investor is 5.29%. The average bond fund investor, 0.44% versus the, oh, I see what this is now. So if you take just the index, so if you took the S&P index, it's at 7.2. Average stock fund investor, 5.29. They came in below, no surprise. Interesting though, on the bonds, the Bloomberg Barclays U.S. Aggregate Bond Index, whatever that is, 4.6% from 98 to 2017, and the average bond fund investor came in just barely over 0, which is sort of interesting. All right, chart number 10, investor psychology will wreak havoc on the average investor, but create opportunities for the greater one. And this is very similar to the first chart. It just kind of puts some emojis or stick figures here, but it's the same thing, right? Which is optimism, excitement, euphoria. Then you get anxiety, fear, desperation, panic, the famous C word, capitulation, that they like to talk about on TV, despondency, depression, maybe some hope on the upturn. And I don't think we've seen the hope yet. You might have had, a fake out there in late February, early November when things started to go back up temporarily. But, it's suffice to say, in my opinion, probably not going to be a lot of hope coming in prior to 2023. It would just be my random guess. I hope I'm wrong, but it just feels like a great year for tax loss selling, in my opinion. So I'm more interested in where the market resumes on January 1st or 2nd or whenever the first day is. All right, number 11, the great investor understands that drawdowns are part of investing. So this chart, as you can see, S&P 500 drawdown since 1928, and it goes through and gives you the dates, the time period, and the number of days. We'll flip all the way ahead to, let's look in the 70s. So from basically January of 73, October of 74, the stock market declined 48%, 630 days it took to get through that whole thing. So that's a long, drawn-out process, and it's probably one that you're going to see a lot of bears showing, like look back in 73. Now, since then, if we move, let's just skip ahead to 2000s. Let's just try to get it in like at least an internet area, our internet era. You obviously have dot-com bust from 324 to 10/9 of 324 of 2000, 10/9 of 02, 900 days. 900 days minus 49% wasn't pretty. And there are companies that definitely resemble, the dot-com bust, that same sort of model of not necessarily producing earnings, but there are other companies that do. So it really just depends on how your portfolio is skewed. Do you see earnings? Do your stocks have an EPS? If they do, and that EPS has a history of increasing over time, then you should be exempt from some of the worry. But if your stocks do not, and they're based on, enterprise value multiples, then it could be bad. October 2007 through March 2009, 517 days, we had minus 56%. That, of course, was the financial collapse of that time. And since then, we have had 70 days back in 2010 of minus 16%. And we've had 157 days and 100 days and 13 days and 95 days. All these are spans of negative movement. And in 2020, we had 33 days minus 33%. Now, right now, I don't know when this chart was created, but it has its place on here. The January 3rd of 2022, the S&P started the drawdown. Whenever they printed it, the total drawdown was minus 13%. I don't know where that stands now, but since we are looking at Jan 3 of 2022, we know that Jan 3 of 2023, very roughly 300 some odd days, 350 some odd days, right? And so that begs the question, how many more days are there to go? If you wanted to get into the 450s, 460s, before you started to think about it, then you're probably in that April 1st range. If you want to get into the 500 days, okay, then you start to push it to the June range of 2023. And if you want to go into the 600s and put you firmly, let me double check, minus the dot-com meltdown, if you want to plug 600 some odd days on there, it's going to take you roughly through October of next year, if you're basing it on days, but days is irrelevant, right? But if you want it to hurt more, and you need it to hurt more in order to feel better about it, you're coming up on 365 some odd days on January 3rd. And then roughly every 3 months, you add 90 to that, okay? I don't know who would base it on days, but I feel, I guess, comfortable that it's been 300 plus days, okay? We're not talking about short term anymore. I don't expect it to go up right out of the gate in 2023, but I think we're now reaching a reverse ticking time bomb where this thing can only go down so much further before it has to turn back around, just on sheer fundamentals of earnings per share. All right. Number 12. This one, not as related, but it is still kind of interesting. Politics does not hurt or help the stock market. And then they just go through here. This is dating back to, what is this dating back to? Oh gosh, all the way back to 1926. And they just show you, Democratic president, Republican president. Obviously, the stock market has went up from there. If anything else, this is a good reminder that you wouldn't necessarily buy the S&P 500 because of who's the president or who's going to be the president. As we know right now, even though some say it's a Democrat problem because stocks are down, there's a lot of factors at play, right? And there's a lot of speculation that Republicans come back this year, and if they do, or in the next presidential election, it'll be funny because if they do, the timing would be very good to start to see more of an uptick because we should have inflation and stuff stabilized by then. But we'll see. Either way, the data suggests no matter who your favorite president is, they probably did not have a ton to do with the greater increases in the stock market. All right, guys. So that is 12 charts to know as a stock market investor. Again, I'll plug this person who I do not know personally. This is Matt Allen on Twitter. Just happened to see it. For all I know, he copied it from somebody else, but thank you, Matt Allen, for putting this together. Sniff asks, are you buying Bitcoin at these levels? I am not right now, although I'm intrigued by it, but I lost everything on Voyager. So it was a very intriguing journey that I took in the Bitcoin space because I was in GBTC, Grayscale Bitcoin Trust, back in 17 or 18, made a few bucks from it, but eventually sold in the midst of the pandemic because it was doubling up, I think, on my original investment. And then, I started reading a lot about people talking about, you need to own your coins and they got to be this and that. So I decided to sell out of that, and I took the money and used it for Voyager, which supposedly lets you transfer your coins out. We know where that world went. Lucky for me, it was small potatoes. Okay, it was probably, I don't even know if it was $3,000 or $4,000, and I'm just considering it gone. We'll see what happens. If you are in the same boat and you're more interested about taxes, I've done some research myself, and one helpful tip I can give you, even though I'm not a CPA, is until the liquidity deal or the bankruptcy deal for Voyager gets settled and closed in court, I can't claim it as a loss because it may not be officially lost yet. So in my case, whatever the amount was I lost on Voyager, and tax season's coming up, I can't claim that until the bankruptcy proceedings have finished. And if they do disbursement, of which I'm not counting on any, then, let's just say they send me a check for $5. It's obviously still going to be a loss, but I have to wait for that whole process. And if you're in the same boat, because I know a lot of those places closed down and screwed us all, you just be careful if you go to claim it on your taxes. I think you got to wait for the process to play out, but talk to your tax advisor. The one thing I will say in regards to Bitcoin is, it makes the GBTC that I was doing even more attractive, given what I went through with Voyager, and it didn't even kill me, right? Some people lost so much, whether it was Voyager or the other ones. In my world, I think for what I care about, I probably chose correctly to invest through GBTC, and I would definitely look at it again just because it's much more public and the leverage ratios and stuff don't come into play. I don't know when I'll get back in. Right now, there's just too many stocks that not are necessarily are fire sales, but are intriguing at these levels. So, Sniff, thanks for coming out. And Russ C just posted a question. What would be your best guess quarter in which the bottom will come? Russ thinks it'll be in the second or third quarter. It's you're flipping a coin. I think for myself, I'm leaning towards an earnings time shift in sentiment. So let me just pull something up here. Yeah, NASDAQ was down 1.49%. So if we take, I'm just going to do Google off the top of my head. It doesn't matter. This could be Apple. This could be anybody. Let's try to figure out where the next earnings are. So the estimated earnings for Google is February 2nd. And now let me pick another one. Let me pick Apple. Apple's estimated at Jan 26. And now let's just do Microsoft for fun. 126. So if those three corporations survive what's going on now and provide, let's just say, I don't think they're going to provide a ton of guidance to the upside necessarily, but if they don't act like the boat is sinking at this point and they manage to get through holiday season relatively unscathed, and we'll also have, we'll be 26 days into January, I could see a turnaround in the market then. If that comes out, and let's just pretend Microsoft had a bunch of contracts canceled for Azure, right? They expected to land certain contracts and they never materialized because of the economy, then I'm in Russ's camp, which would be second quarter or third quarter before we saw something turn around. These, in my opinion, the tech companies, the big tech, the profitable big tech, semiconductors, Microsoft, Google, take your pick, if they can survive and limp into that earnings season with at least showing, that they're holding their ground, then I think that things start to turn. But if we wake up, say, for example, and Amazon and Apple say consumer holiday sales are absolutely awful, and then everyone's going to be worried that the virus spreads, right? That the virus spreads from the consumer to stocks. That's how I'm looking at it. It does seem like retail sales are down a little bit from some of the news sources that I read, but there's only, if it's Macy's, I don't really care, right? I want to know Walmart sales, Target sales, on the lower end of the retail spectrum, if you will, where there's affordable gifts to buy. And then we need to worry about the high end, which would be Apple to some degree. How many phones are they selling, etc. It's such a mixed bag on Apple's readout and holiday. I've seen everything from them, saying that they were lowering demand for this model, but then they turn around and say, maybe the 14 Max or whatever the Superstar is down from projections, but then the baseline model is up. So where the hell does that put you, right? It's very hard to tell yet. So Russ, not a direct answer, but I could see things bumping up after earnings if everyone survives through this Q4 or traditional Q4. And then if not, man, if it's bad news, then I'm with you. At that point, I'd probably lean more towards Q3. So no matter what, I would definitely say if you have stocks with earnings and your cost basis isn't awful, even if it's down, if these are companies that generally speaking will increase earnings over the next 3 to 5 years, just hold on to it. What's the difference? You know, average down a little bit. If you bought more speculation and there may not be any EPS in the future for some time, and they're at risk of not growing at the same pace that they were, then those are the ones that you're going to have to say, maybe I take some tax loss harvesting, or, you know, you don't have to sell all of everything, just sell, you could sell 5 shares. If you own 120 shares of a company, you could sell 5 or 10, lop off some of that cost basis and hang with them for another year. And then if not, sell next year, right? You still get the tax savings. All right, guys, hope everybody's doing good. Appreciate those who came out. We will see you on the next video.